Yep.
Okay, great.
Wonderful.
I muted too many people. So what we're going to do is you can see I have the Illustrator up here, and it just opens, not opens up, it opens up to this page, and you're going to pick, your state. We'll just leave it Illinois for now. There's a drop down there. You're going to typically leave it on basic illustration. There is something called an insurance benefit concept. That's the IBC illustration panel. So we don't always run that. We run that typically when we're trying to look at repeat loans and things like that. I want to start with just the basic illustration because that's what you're going to use. We generally just want to show them that the capital is there. However, if you have a system that you are going to be using where loans are, you need to show those, we can do that as well. But I want to start with the basic. You're always going to have whole life. It's going to default to that. You're going to switch your product. I think it usually defaults to this. I had a different product open, but the product for Infinite Banking is called Horizon Value. And now if you were on the call or saw the recording last week, we use Horizon Value because we focus on those high early guaranteed cash values, highest early guaranteed cash values in the industry, bar none, and sometimes higher than the guarantees all the way through the contract of other carriers. So it just depends on the client. But you also have an incredibly flexible paid up additions rider. So in the past, I've said, it's important to say, to know what the interest rate is that you're earning on the cash, right? But that's only half the story. You have to know that there's actually going to be cash in there to multiply by, because 0 times 4% is still 0, right? So we do that. We front that cash value in there, so the client can start using their Infinite Banking concept right away. And again, we have clients who send in illustrations, they send in their applications for the policy, and they also send in the loan form to get the loan. One-page form, they fill it out, send it in, and then as soon as the policy is in force, we process the loan. So that's why we use Horizon Value, because of the design of it, and the administration of it, the flexibility that we have around accessing those cash values immediately as soon as they're available. So I'm going to now click on the OK button down here at the bottom. And we're going to go into the illustration pane. So you see a series of tabs at the top. And then Ryan, I'm going to have Ryan just kind of take over here and tell me what he wants to do. Ryan?
Awesome. Thanks, Kip. So for this example, I'm thinking, like Kip mentioned, let's start with the basics. So we'll just plug in a valued client, and we'll keep a male, age 35. We're good there with the age and gender. If you needed to, you can always change that risk class. Yep, right there where Kip was showing you. Let's say for this instance that male is going to be preferred. He's a really healthy guy. Let's change him to preferred non-tobacco and run a preferred case. All that additional information down there, address and all that, is completely optional. If you want to fill in your client info, feel free. But in today's instance, we're going to go ahead and just bypass that. It's not necessary. So from here, we can actually head over to the Plan Design tab and begin a typical case design for Infinite Banking. And now, when we're talking about case design for IBC, we're generally working with an allotted premium your client has, whether that's money found, inefficiencies, spending inefficiencies, sat down with the client and found out, hey, let's redirect this money into this policy. Wherever that money is coming from, we're typically designing a policy based on that premium and not generally a death benefit. The reason being, we want to make sure that based on that premium or dollar that the client has to spend, we're designing this case to be really as efficient as possible in accumulating cash that's liquid within the policy. So for this instance, let's say the client's going to have $1,000 a month. We're going to change that first drop down Kip's hovering over to money purchase. And that's ultimately telling the software, hey, we're solving via a money purchase or an allotted premium. It's going to default to $1,000, so we're good there. But again, on your circumstances, you might be playing with that and changing that modal premium. We are going to change that mode from annual to monthly though, because in this circumstance, we're going to pretend she's got $1,000 a month. Now, based on this quote right here, if we hit run, it would purchase just $1,000 of base coverage. Now, IBC though is comprised of a couple different pieces of coverage. We've got that base Horizon value that Kip mentioned is the product that works really well with IBC. And it works really, really well in conjunction with our paid up additions rider, which is what's accumulating all that early cash value within the policy. So we need to add that PUA rider by dropping the premium design down to level FlexPay PUAR purchase. It's going to be that fourth option there, Kip. And what that's telling the illustrator is that we want a level PUA purchase. So we want that premium to be consistent. We're also actually, while we're at it, going to check that input amount right there, a little bit above. And we're going to leave that default to 100,000, which is actually that Flex PUA's maximum annual premium within the product design itself. So that's just going to open up that ceiling for the max amount your client can pay into the PUA rider. Now, so that from number, here,
by the way, can go higher. Sorry, Ryan. That number can go higher, that 100,000, but that's our ceiling for typical illustration. And of course, it's going to be based on the client's financial qualification. So whatever they actually qualify for is going to actually dictate what that and the overall premium is going to dictate what that number is.
Awesome. Thanks, Kip. Now, with a typical IBC case design, we're generally utilizing about 60 to 65% of the overall premium in paid up additions. I typically run mine at 65. It's going to be a preference though. So for here, let's go ahead and plug in 650 right there on the FlexPay PUAR modal premium. And because we have level FlexPay PUAR purchase selected, what that's saying is we want a level $650 a month purchasing paid up additions of our $1,000 total premium. And now from here, let's go ahead and actually just run that.
Here, the paid up additions rider. Can you hear me?
Yep, we can hear you.
Okay, there's a really long delay, I guess. But just to mention that PUA rider is very cash rich, and that's why we're using so much of the premium to go into that paid up additions rider. You put in $94, for example, or I'm sorry, $100, for example, $94 immediately shows up. So, and there's no surrender charges. And then it starts earning 4% guaranteed at the gross rate, but it's a lot of cash value in there. It's earning 4%. So that's why we're using this paid up additions rider, and it's very, very flexible. It's easy to you can put any amount of premium in up to your maximum at any time, no matter what the mode is on your check. It doesn't matter, monthly, annual, it in on a Wednesday. It doesn't matter. So that's where I just want to make sure we understand why we're using that paid up additions rider. So I'm going to go ahead and run this, and then Ryan, please take over.
Thanks, Kip. So head on over to page 2 for me, Kip. And page 2, guys, is going to give you a breakdown of all the coverages on this particular case design. And the first thing I like to take a look at when I'm designing an IBC case and making sure it's ran right is in the top right corner that we have that total initial monthly premium. And we see that's $1,000 up there, which is good. We're designing this case for this lady for $1,000 a month. So we're good there. And the next thing I like to take a look at is the individual pieces of coverage themselves. Kip, let's highlight real quick that blue margin to the left, specifically the primary insured coverage right there. Because this blue margin.
The screen is covered. I don't know how to move the control panel for the Zoom is covering my button. Let me see if I can do it this way. All right. Where's the highlighter, Ryan?
The highlighter is going to be in tools. And there's going to be, let's just draw an arrow. Let's draw an arrow there.
Okay. How do I do that?
Go down to draw arrow. Click draw arrow.
Draw an arrow. There it is. Okay. All right.
And then highlight that.
And so what do you want to highlight?
Margin to the left. The margins to the left that give you kind of a breakdown of what we're looking at to the right. So specifically primary insured coverage. Right there. Yep. And ultimately, that's giving you a breakdown of the base coverage. So, Kip, could you maximize that for us, and we'll take a look at that?
Yeah, just a sec. There we go. Figure out how to move this thing. There we go.
Awesome. And so primary insured coverage to the right of that, it's giving you a breakdown of just that, the base coverage for that main insured. And so we've got a base coverage face amount on the horizon value of $368,891.49. That's the initial death benefit that $5,009 is purchasing of horizon value. And again, if we look at the margins, that flex pay coverage is going to detail the flexible paid up additions rider that Kip was mentioning. This is the where all that cash accumulation within the policies really generating early on in this contract. And this is what we were ultimately funding, either 60 to 65%. So if we take a look at that initial premium, the initial premium is $582. And right there, we can tell, hey, we're a bit shy of that 65% mark that we wanted the illustration to be at. And the remedy for that ultimately is going to be purchasing a bit of term insurance. And the reason we're doing that is ultimately because this PUA rider is cutting off at 582 due to the MEC guidelines. It's saying, hey, this policy is too cash rich for the amount of death benefit we've got on here. It's going to MEC. We're going to cut it out at 582 so it doesn't. In order to remedy that, we're going to add some additional death benefit to ramp up that calculation in our favor. And the most affordable way to do that is going to be via term. So Kip, if you could hit that little highlighter in pencil for me. And head over to riders. We're going to double click that primary 10-year term rider, and we're going to add some term insurance on here. And ultimately, I'm going to add 50,000 right off the bat. It's going to be a kind of a trial and error thing for a while until you realize kind of the relationship of death benefit towards premium. But 50,000 is going to be a pretty good starting number. Go ahead and hit OK and rerun that, Kip. And then we'll see ultimately the changes to the policy with that new term coverage added.
Thinking. There we go.
And so now this is exactly what we wanted to kind of show you guys. We're much closer now. We're at $639.79 if we're looking at the initial premium for that flex paid up additions rider. Still shy of the $650 we're looking for though. So you know that death benefit is helping out, and you know it's getting us closer to that overall goal. We're just a bit shy still. So Kip, go ahead and change it to 100,000, and we'll be good to go in terms of the case design from here. Excellent. So we see the 650, and then what else happened, because we have plenty of death benefit, is we see that maximum annual premium actually went up too. And the really unique features about this flex paid up additions rider, Kip mentioned it was really flexible. A great thing is that minimum annual premium your client needs to pay in order to keep this in force is only $100 annually. They only need to pay $100, and this PUA rider will remain in force and can be funded. But they can fund all the way up to the maximum. So based on this structure right here, we're already funding $7,800 into the paid up additions rider on an annual basis, but your client can go all the way up to that $9,206. So ultimately, if they have a couple $100 extra at the end of the month, get a tax return and are looking for a place to put that $1,400, this is a great place to overfund the PUA and really just see a lot more cash accumulation build within that policy above and beyond what we're already illustrating. Which kind of brings us to our next point, Kip. You want to bring them to the ledger so we can kind of see how this policy is doing cash-wise?
Yeah, before I do that, can you hear me right now?
We sure can.
Okay, there's a delay, so I don't want to talk too fast. The other thing to remember is that with that extra room we now have in there in infinite banking, in the infinite banking concept, there is this concept of being, or this philosophy of being the honest banker. So meaning that you have access to a loan at 5%, well, 4.76. All right. So if you're the banker and you're pretending you're the banker and you're using your own policy as collateral for a loan from the life insurance carrier, that's what you're doing, because your cash, remember, your cash value stays in your policy. It does not come out. We're not taking loans from our policy. We're taking loans against our policy cash value. So you're paying 4.76 for that. It comes out to about 5 after you go for a year. So we'll say 5 for simplicity's sake. 5%. All right. Let's say that your next available loan, if you had not set up your bank, your next available loan rate would be 7%. So what you can do is, if you want to really juice up your savings even more and start, earning interest on that other interest you would have spent away, you take those other 2 percentage points that you were going to pay to some other financial institution, and you direct it over the course of your loan. You direct it into the paid up additions rider. As you're paying your loan back, you're also putting 2 percentage points worth into the paid up additions rider. Okay, so now it's going into that paid up additions rider, and you're growing your wealth instead of the bank. Okay, that's what you would have done had you not set up your bank. So I just wanted to throw that in real quick. Okay, Ryan, we're going to go to the basic illustration. Is that correct?
Yeah, basic illustration is great. And so we see here in year one, of the 12,000 we paid, we have 7,800 in available guaranteed, or 7,200, I apologize, guaranteed cash value within the policy, which is really pretty great. If we wanted to, we could juice it up a bit more by changing that ratio and funding a bit more into the paid up additions rider. But that 65, 35, 60, 40 split is really a really strong starting point in terms of both early cash accumulation and long-term cash accumulation via those dividends. So this is where you'll get a breakdown, obviously, of cash accumulation. You see that death benefit continuing to grow as well, because as you're funding that PUA rider, you're purchasing additional paid up insurance that has a death benefit associated to it as well. So really a great concept for you guys to be getting into.
Yeah, and sometimes these cases can be designed with just a couple clicks of a button, right, Ryan? Can we show that? Like taking off everything and just over with just max accum?
What's that, Kip?
Can we show them just how easy it is to run the max accum solve?
Oh yeah, absolutely. And why don't we show them that actually on a child? Because we ultimately see a lot of these individuals who realize the power of IBC, wanting to get this started on their children or younger family members. So why don't we work through what this would look like on a child, as well as showing them Max-Accum on the
Yeah, let's do that. So I'm going to remove this. Okay, I'm going to go to client. All right. And then what do you want to use for age, Ryan?
Let's do like a 7-year-old girl.
Okay. Oh, yeah. Okay.
And we saw that risk class change. Standard's going to be the only available risk class for minors. So we're good there. We've got that gender as female, and we can head on over to plan design. Now, keep in mind when we're doing this, ultimately the client's goal, IBC focus is primarily that cash accumulation. But at the end of the day, this is ultimately life insurance and needs to qualify as such. So in terms of coverage amounts, generally children qualify for half the amount of the least insured parent. So as you're prospecting and working on children's cases, just keep that in mind. Generally, we're not seeing children get approved through underwriting for, say, giant $1 million policies. That's going to be a little tough. But nonetheless, a couple $100 a month is certainly not unrealistic for these IBC policies for children. So let's with that in mind, go ahead and select maximum accumulation solve. And let's say the mom's wanting to buy this policy for the child, kind of ramp up a college savings, and wants to put $200 a month in the policy. Take a look at what that looks like. And so, like Kip said, it's just a couple clicks of a button, and it's that simple. And now, Kip, let's head over to page 2 real quick, just to show them ultimately what that maximum accumulation solve's doing. And so what this maximum accumulation solve's doing is it's ultimately purchasing that same horizon value base coverage we used on the example right before this, as well as paid up additions, and it's purchasing as much PUA as possible up to that MEC line. So we take a look, this policy is not going to be a MEC, and that's what that maximum accumulation solve is doing. So we're almost at a 50, we're a little over a 50-50 split here between base and PUA coverage. And that's going to give us a decent amount of cash accumulation within the policy for this 7-year-old. And so if we scroll through, Kip, and let's take a look at say maybe the cash accumulation around her college age.
So here.
Awesome. Yeah. So by 19, 20, when she's getting ready to go into college, 18, just looking at a little over 20 grand in guaranteed cash accumulation from a policy like this. So really a great way to kind of get your life started.
Right. And remember, when you use cash value from a life insurance policy, or when it's in a life insurance policy, the cash value doesn't show up on the FAFSA form. So that's the application that everybody has to fill out for financial aid, and whether you get it or not, you have to fill that out. And so that'll end up not counting against your contribution, what the government or the school sees as your contribution to the cost of education. And so that can impact the loan that you receive, the subsidized loan, or even the offer from the college itself. So again, there's another advantage to having that cash value inside your life insurance contract.
Yeah, great point, Kip.
All right, so case, we've run, kind of two basic, I mean, that's basically it. I mean, when you're dealing with these illustrations, it's not that difficult. It's, setting the PUA writer to what do you want to see it at, and then adjusting a term writer if need be to get it to where you want to go. And the system in the background is always watching for MEC and trying to prevent MEC the whole time unless you tell it not to. So with that case, do we have any questions? Do we have any cases that anybody would like us to run? I'm going to unmute everybody just in case, just in case their case. Let's see here. Are you unmuted, Case?
Yes, I'm unmuted.
Oh,
yes. So, yeah, team, if you guys have any thing you like to run or see, or a special case study that you or scenario that you like to see, feel free to ask away. Okay. We still have about 20 minutes here, so
Okay.
we can run at least one or two scenarios
Sure.
for you guys to look at. Yeah.
Sure. Yeah. So if anybody has, let us know, and otherwise we'll make it up.
Looks like there's a question from Moses.
Okay.
Yeah, great question, Moses. So ultimately, it's going to kind of depend on what we're looking to do. If we're ultimately taking policy loans to pay for that college, policy loans, you can loan up to maximum 95% of the available cash value within the policy. And then if we're ultimately looking to just take a straight withdrawal from the policy, pay off the college, we're looking at taking withdrawals up to the cost basis paid into the policy. So kind of two different calculations.
Right, and there's different ways to access those funds, as Ryan just mentioned. You can withdraw them up to the cost basis, but typically what you're going to want to do as an IBC practitioner, and whether you are or not an IBC practitioner, is a lot of times you just want to take loans against that policy, and you tend not to do it right away. You tend to wait and use up all the other resources that you have as far as grants and loans and if it's a subsidized loan, you don't want to start paying that off right away. So what that's going to do is give your policy some additional years to accumulate more cash value and make it even more beneficial after college to start paying things off. If you can do that. And that's what happens a lot of times for individuals who use this kind of planning, is they're going to have grants, they're going to have subsidized loans and what have you. That's pretty typical. So that's going to give us another 4 years roughly. And you can see there in 4 years, she's got about $30,000 more, or I'm sorry, $30,000 total instead of 21. So yeah, that's a great question. The question, I don't think we said the question, it was how much can the parents take out for college? How much can they withdraw? So that was the question. So hopefully that made sense. Any other questions or cases?
Yeah, this is Steve Dutson. I have a client that wants to leave inherits some money to his grandchildren, and they're all under age 18. Can he put money, a lump sum in there, like $1,000 or $10,000 or $100,000, and let that ride till they get about age 60?
Well, typically you wouldn't use that for a juvenile, someone who's younger, because if you just do one lump sum payment, it's going to be a modified endowment contract. And then they're not going to have any of those tax benefits that life insurance is known for. But you could feed that in over a few years. Ryan, do you want to talk about how we could feed it in over a couple of years?
So much a year, huh?
Right.
Yeah, absolutely. What sort of premium were we talking about here, Steve?
Well, he probably wants to leave his grandkids somewhere between 10 and 100,000. He's worth millions, but he's he wants to leave something for his grandchildren. But another thing, once they turn of age, or if he dies, then they have to transfer it over to another owner, right?
Right. So
Yeah, so I mean, ultimately, if he'd be listed as an owner and passed away, it would either, depending on kind of how the policy would be set up, either go to his estate, and ultimately we could change that ownership via some documentation and change it to, say, either the parent or ultimately the children if they're of age. There's some steps we could take to kind of set it up how we need to.
Could we set up
In the event he says.
A trust and put it in the trust as the owner?
sure.
Absolutely.
Okay, that's probably what we would like to do, because we deal with wills and trusts as well.
If he ultimately, if the cash value isn't going to be accessed, he could do it as a single premium. We have another product called Horizon Legacy, and it's a very strong single premium product. So he could do that. We just would want to make sure that they're aware of the tax consequences of that.
Yeah, but if ultimately a legacy transfer is really what he's looking to do, provide those individuals with a substantial death benefit, we'd probably be looking at, like Kip mentioned, that legacy over an IBC concept. But if he's looking for ultimately something that he has the ability to leave some death benefit behind, but also utilize that cash value and keep liquidity within that, this is the sort of policy for him.
So the Horizon Legacy would be the policy to use, huh?
Yes, for a situation like that, it would tend to, for a lump sum single premium, the Horizon Legacy is a great option.
Okay. Thank you.
Mm-hmm. All right. Any other questions or Case? Did you want us to run a particular proposal?
Yeah, if you have another scenario, you can. We still have about 15 minutes here, so if no one has any other questions, yeah, we can do a quick one, and we can do another one. Yeah, for everyone to see.
Okay. Ryan, have you ran anything recently that sticks out in your mind that we maybe could use?
I mean, we do really kind of a lot of IBC. The typical case design would be kind of what we just ran, but why don't we run something a little more out of the norm? Why don't we do a larger IBC case then? Say maybe
Okay.
50,000 in premium a year.
Okay.
40-year-old.
Okay, yeah, that's good.
You want to do male, female?
Yeah, male and yeah, preferred. That's great.
All right. You just want to run it max accum?
Yeah, let's show them that max accum 40,000. Because ultimately at 40 and preferred, we're going to get some pretty good performance out of that, and we're not going to have the ART rates from that term rider renewing. So
Right.
that'll look pretty good.
Right. And I'm going to click OK there. So I changed this to an annual mode. And I changed it annual. So this is $50,000 annual. And this might be like a business owner. And we do have cases like this that come up. We have some business owners out there, and they really like IBC, and they really understand it. And they understand the the tax advantages and the advantages of actually they can have the policy act as a source of a loan. So the client would typically own the policy, and then they can make loans to their businesses, and there's rewards that I can't, tax benefits to doing that I can't really speak to because I'm not supposed to. So, but there are things you can do with that tax advantages by owning your policy and making loans to your business.
Absolutely. Absolutely. And then Kip, from here, let's just show them, let's go back in an edit proposal, and let's say in this particular scenario, your client really wants to fund this 50 grand in the policy, realistically until about retirement age, 65, and then kind of wants to be done with it. So hit that edit proposal for me, and we'll RPU this at 65, just
Okay.
to show
And-
them that option as well.
Okay, and I'll do that. And then just to show you by itself, it solved that we are getting of the 50,000, 29,178. That's how much is going through into that paid up additions rider, and then about 21,000 for the base policy premium right there. And you got about almost $1.5 million in coverage. So I'm going to go over to the plan design tab now, and I'm
Yep.
going to.
And on the right hand side, right there, and let's leave it default to 65 because that's a pretty common retirement age. And hit run. And so let's in this instance, we got a business owner looking to pay 50,000 in, but let's say retirement age, maybe he's going to sell the company to his son or something, and doesn't necessarily need to fund 50 grand into a policy like this at retirement. He RPUs the policy and has a paid up death benefit of a little over 3.5 million at the end of the RPU, and still retains access and liquidity to all that cash value in the policy with no premiums being paid into the contract thereafter.
Right, and it just keeps going from there. So if he is lucky or unlucky enough to be still around at 120, we'll just say, here's your money. So there. And of course, in whole life, the death benefit has to match the cash value at the time of endowment, at maturity. At maturity, the death benefit always matches the cash value. It's just a matter of what path the cash value takes in getting there. And we push that path in the early years to take advantage of the cash value when they're still, growing their wealth and using it to make investments and what have you. Okay, and then with that, Ryan, do we want to show them maybe they need to boost up that cash value a little bit? Maybe we need to add a term rider?
Yeah,
for their purposes.
Absolutely.
So what we would do is go to here, and then Ryan, I'm going to let you tell me what to do now.
Yeah, awesome. We're going to have to switch that Max-Accum back to money purchased like we originally ran. And we're actually going to change that premium design. We'll leave the total premium amount alone, and we'll change that to level FlexPay PUAR. And yep, default that to that 100,000 always. And from here, let's say you wanted about 80% of that premium going into the PUA rider. So really juice up that cash early on. Go ahead and plug in 40,000 there. And then head over to riders, and we're going to need pretty much quite a bit of term in order to ultimately fund the PUA rider at that level. So I'd say let's go ahead and start with maybe 350,000. And so see, we're still shy a bit of that 40,000, but in the right direction. So I'd probably just bump up that term amount to say 500,000.
Almost.
Of course. Yeah. Let's just do 650. That should get us there.
Close enough.
Yeah, pretty close.
Now there's another way to do this too, with the term rider, adjusting the term rider. You can start out with the maximum. So under mutual trust terms, we will allow, or rules, we will allow a policy to have a term rider, so the 10-year term rider, that is 10 times the face amount of the policy. Okay, so if you have a $50,000 base policy, you can have $500,000 or $500,000 in term coverage. That's the max we allow as a company. So in order to maybe take a different approach and see what the maximum is available to you given a certain premium level, you can plug in a really high number. We usually use like 9 million as your term rider face amount. And you do that, and then it's going to show you, okay, given this policy design, here's the max you can have for term, and that's going to make 80% or 90% of the premium go into the paid up additions rider. Now, of course, that's not the way you want to design it, but that gives you a starting point to say, okay, let's back this down now. So you can go up like Ryan did, or you can go down, starting out really high and going down. Okay, just by using a really high number on your term rider.
Yeah,
And Ryan?
There is a question from Tor.
Okay. Let's see. Can IBC be funded with a lump sum? Yeah, we kind of talked about this earlier, Tua. So typically, no. You generally want to have a continuing ongoing premium, because if you put it in a lump sum, it's going to mech the contract. It's just too much cash value to prevent it from meching with one single premium. Ongoing premium, again, as long as it's relatively a similar premium every year, not similar, but an ongoing premium every year. That's easy to not mech, but it gets really hard to prevent mech when you're just talking about one single payment.
A question on that. If say they have a lump sum, maybe 500,000, if they spread that over 5 years, that would work, and pull it out of a fund, 100,000 every year for 5 years. Would that work?
Absolutely. That'd be great. Yep, no problem there at all. So yeah, the closer you get out to 7 years, the better. But we can certainly do 5 years. Absolutely. We can even go down to 2. You don't see it too often, but if you split a single premium into 2 years, over 2 years, that typically can work well also. So any other questions on that, or anything, Case, you'd like us to address?
That'd be a big tax advantage. For instance, if they spread it over 10 years, that would be a big tax advantage, right?
Absolutely. Yeah, depending on their tax situation, obviously, but yeah, they would have tax-free growth, and if they access the funds properly, they would have income tax-free distributions.
Yeah.
Okay, guys, any other questions for Kip and Ryan? Okay, all right. If no further questions, thank you very much, guys, and thank you very much, Kip and Ryan. Next week, we will actually launch a software that will help, with the debt elimination process using a participating whole life for debt elimination. Pay off debt, pay for future expenses, reduce taxes, reduce interest payments, and also increase retirement savings. So same time next week, Tuesday, 3 p.m. Central Time, we will launch the software. If you haven't seen the software, make the time to join the webinar next week, and we will roll out the software. We're actually going to use MTL's illustrations for the import as well. So we'll run MTL's numbers and show you guys how the debt elimination works with the system. So looking forward to see everyone again next week. Thank you very much.
Thanks, Case. Thanks, everybody. And thanks, Ryan.
Thanks, guys. Yeah, absolutely. Thanks for having us.
Thanks.
Thank you.